When people ask me about the beginning of my investment career, they often expect to hear about a brilliant insight or a fortunate connection. But the real story is far more instructive, and it began with what looked like a major setback. It was Ich and Joe by Sir Joe. I was 27 years old, recently graduated from Oxford with a Rhodes Scholarship and what I believed was a solid understanding of markets. The world was on the edge of conflict. Europe was in turmoil. Caution dominated Wall Street, as it had for most of the decade after the crash of Ich by Sir John. And I had what my family considered a highly unusual idea. I wanted to borrow $10,000, which was a meaningful amount of money at the time, to buy 100 shares each of every stock trading on the New York Stock Exchange for less than $1 per share. My family thought the plan was unreasonable. I was newly married, and they couldn't understand why I would take on debt to purchase what the market seemed to have dismissed as worthless. These weren't established blue chip companies. They were the neglected ones, trading at token prices because public opinion had written them off. Okay, my mother was deeply concerned. My father was silent for several days. Several days. My brother told me I was risking everything I had worked for at Yale and Oxford. Even my wife, Judith, though supportive, must have wondered if I was making the right choice as she watched me call brokers to put this plan into action. The financial community considered it eccentric. One broker I contacted even laughed and asked if I was being overly optimistic. But I had studied market history carefully. I had lived through the later years of the Great Depression. I had seen how extreme pessimism often created opportunities that defied conventional reasoning. And I understood something essential that my family understandably could not see. I was not taking a reckless chance. I was making a calculated decision based on mathematics and history that suggested the odds were on my side. Let me clarify this distinction because it forms the foundation of everything I teach about investing. Investment is fundamentally different from speculation. An investment operation, after careful analysis, seeks preservation of principal and a reasonable return. Any operation not meeting those conditions is speculative. When I borrowed that $10,000, and I should note that it represented nearly all my available resources, I was not gambling. I was following a rational, evidence-based approach. The numbers were straightforward, though they required looking beyond the prevailing anxiety of the time. Out of the 104 stocks I purchased, 34 were in bankruptcy proceedings. That sounded alarming to my family, but it didn't worry me. Bankruptcy does not always mean total failure. Many companies reorganize. More importantly, I had diversified so widely that even modest gains among the successful firms could offset the weaker ones. The key psychological factor was the extreme pessimism in the market. Investors had become so negative that prices reflected an assumption of no future recovery. This was Mr. Market, a metaphor I'll discuss later, at one of his lowest emotional points. He was offering me businesses at prices lower than their cash holdings or asset values. The market was saying, these are worth very little, while sound analysis suggested these have genuine value that exceeds the current price. A few days after I made these purchases, the market continued to decline. News from abroad grew more concerning. Then came a margin call from my broker, a demand for additional collateral. I had none available. For 2 days, I faced the possibility of a serious financial setback, losing the borrowed funds, damaging my professional prospects, and disappointing my family. I couldn't sleep. Judith would find me at 3 in the morning, sitting with financial statements spread across our tiny kitchen table, recalculating, reanalyzing, asking myself if I had made a catastrophic error in judgment. Had I confused courage with recklessness? Had I mistaken a depression price for a permanently lower valuation? These are the questions every investor must face at some point, and they reveal whether your decisions were based on sound analysis or mere hope. Okay, but here's where discipline and methodology save you from your own terror. I went back to first principles. I recalculated the book values, the liquidation values, the historical earnings during better times. I looked at which companies had management that was still fighting, still operating, still trying to create value, and the mathematics still worked. The margin of safety, this concept is so important, was still there. Yes, the market was pricing these securities lower, but the underlying businesses hadn't fundamentally changed in 5 days. The market's opinion of them had changed, but opinions are not facts. That margin of safety concept deserves elaboration because it's the cornerstone of intelligent investing, and it's what allowed me to hold on during those terrifying days. When you buy a security, you must always assume that your analysis could be wrong. Human beings are fallible. Our projections can be too optimistic. Unexpected events can harm businesses we thought were sound. Therefore, you never pay what you think something is worth. You pay substantially less. This difference, this cushion between your purchase price and your carefully calculated intrinsic value, is your margin of safety. It protects you from errors, from bad luck, from unexpected developments. In my case, I had calculated that these 104 companies had an aggregate value, even in depression conditions, substantially higher than what I paid. Even if I was wrong about many of them, even if a third went to zero, which they essentially had already, being in bankruptcy, the remainder only needed to return to modest valuations for the portfolio to succeed. This wasn't optimism. This was mathematics with a margin for error built in. The market, you see, is not some omniscient force that knows the true value of everything. This is perhaps the most important lesson I can share with you. The market is people with fears, hopes, bills to pay, pressures from clients, career concerns, and all the emotional baggage that human beings carry. I like to think of the market as a partner I'll call Mr. Market. Imagine you're in business with this partner. Every day, Mr. Market comes to you with a price at which he'll either buy your share of the business or sell you his. Now, Mr. Market is rather peculiar. Some days he's euphoric, seeing nothing but opportunity ahead, and he names a very high price. Other days he's despondent, seeing nothing but disaster, and he names a very low price. Here's the crucial insight. You don't have to trade with Mr. Market just because he shows up with a quote. His psychological state is his problem, not yours. The value of the business you own together doesn't change dramatically from day to day just because Mr. Market's mood swings wildly. In September, Ichenju by Sir Jolt, Mr. Market was suicidal. He was offering to sell me shares in American businesses with real assets, real products, real customers for pocket change because he was convinced the world was ending. My family saw Mr. Market's despair and thought it must reflect reality. But I saw it as an opportunity to buy from someone in the grip of irrational fear. And then the miracle that isn't really a miracle at all when you understand probabilities. The stocks began to recover. Not all at once, not all of them, but enough of them, and by enough percentage points, that within months the entire portfolio was profitable. Within 4 years, I had quadrupled the investment. More than quadrupled, actually. I turned that borrowed $10,000 into $40,000. I paid back the loan with interest, vindicated my strategy, and, perhaps most importantly, earned back my family's respect. My brother, who had called me a fool, asked me how I knew it would work. I told him I didn't know. Knowledge was impossible. But I had calculated the probabilities, maintained a margin of safety, and understood that Mr. Market's pessimism had created a mathematical opportunity. My father, a man of few words regarding matters he didn't understand, simply nodded and said, "Perhaps you've learned something the rest of us haven't." My mother baked me a pie, which was her way of apologizing without saying the actual words. Okay? But here's what I want you to understand. I could have lost everything. The line between courage and foolishness is not always clear in the moment. What separated my action from mere speculation were several key principles that I've followed ever since and that I believe are essential for anyone who wishes to invest intelligently rather than gamble. First, I did my homework. I didn't just buy stocks because they were cheap. I analyzed financial statements. I studied the businesses. I understood what assets they held, what their earning power had been in better times, what their management was attempting to do. This is what I later taught at Columbia, what became formalized in the principles of security analysis. The idea that a security represents a fractional ownership in a real business that can be analyzed, valued, and compared against its market price. Second, I diversified. I didn't put all $10,000 into the single stock I thought was best. I spread it across 104 different companies in different industries. This is what I call diversification as protection against ignorance. Even with thorough analysis, I couldn't know which specific companies would succeed. But by spreading my risk, I ensured that the inevitable failures wouldn't destroy the portfolio. The mathematics of diversification are quite clear. The more uncorrelated assets you hold, the more you reduce the impact of any single error. And third, I understood the difference between temporary and permanent capital loss. When those stocks fell further in the first 5 days, that was a temporary quotation loss, mister. Market was offering me an even lower price for my holdings, but I hadn't sold, so I hadn't realized a loss. The businesses themselves hadn't changed. This distinction is crucial. If you buy a sound business at a cheap price, fluctuations in the market price are irrelevant unless you're forced to sell. That margin call almost forced me to sell, which would have converted paper losses into permanent losses, but I managed to hold on barely, and the temporary fluctuation eventually reversed. Fourth, I bought when others were fearful. This has become something of a cliche in investment literature, but people rarely understand what it actually means in practice. It means borrowing money you can't afford to repay if you're wrong. It means having your family think you're insane. It means lying awake at night questioning your own judgment. It means facing the very real possibility of complete failure. Fear is not an abstract concept in market bottoms. It's a visceral, physical sensation that tests whether you truly believe your analysis or whether you were merely posturing. Yeah. Now, let me address something important. I do not recommend that most investors attempt what I did in Ichenju by Sensujo. In fact, I would counsel strongly against it. Using leverage, borrowing to invest magnifies both gains and losses. For someone without experience, without thorough analytical skills, without the emotional temperament to withstand pressure, leverage is almost certain to lead to disaster. What I did worked because I had done the analysis, understood the mathematical probabilities, and had the discipline to hold through the terror. Remove any one of those elements, and the story ends very differently, probably with me working some ordinary job and never speaking of investments again. Yeah, this brings me to an essential distinction in investment philosophy, the difference between the defensive investor and the enterprising investor. Most people should be defensive investors. There's no shame in this. Indeed, there's great wisdom in it. The defensive investor recognizes that beating the market consistently requires extraordinary effort, skill, and temperament that most people simply don't possess or don't want to devote to investment. The defensive investor therefore constructs a portfolio designed not to maximize returns, but to provide adequate returns with minimal effort and emotional distress. What does this mean in practice? For the defensive investor, I recommend a simple allocation between high grade bonds and common stocks, perhaps 50-50, though this can vary based on age and circumstances. The stocks should be purchased when their price to earnings ratios are reasonable, not when everyone is excited about growth prospects and bidding prices to the sky. The defensive investor rebalances periodically, perhaps once per year, selling what has appreciated to buy more of what has declined, thus maintaining the 50. This mechanical approach removes emotion from the equation. It forces you to sell high and buy low without requiring any particular insight or courage. And here's the beautiful part. This simple approach will outperform the vast majority of professional money managers over the long term after costs and fees with far less effort and anxiety. The enterprising investor, by contrast, is willing to devote substantial time and effort to research, analysis, and the emotional discipline required to act contrary to crowd psychology. This investor studies financial statements, calculates intrinsic values, maintains a margin of safety in every purchase, and has the patience to wait for Mr. Market's depressive phases to offer bargains. This is what I attempted in each Jubaite Sensor Joel, and it's what I'd practiced throughout my career. But I must emphasize, it's not for everyone, and there's no dishonor in admitting you don't have the time, interest, or temperament for it. Let me share some specific principles that have guided my approach over the decades. Principles forged not in theory, but in the crucible of real markets, real losses, and real terror. Principle one, understand what you own. This sounds obvious, yet it's violated constantly. Before I bought those 104 stocks in Ichenjo by Sensorjo, I studied the financial statements of every single company. I knew what assets they held, what their capital structure looked like, what their earning history had been, what their business actually did. When people asked me during those terrifying 5 days whether I was worried, I could point to specific facts. This railroad company owns track and equipment worth more than the stock's current valuation, even in liquidation. This utility has a monopoly in its service area and a regulatory structure that protects profitability. This industrial company's plant and inventory are worth twice what I paid for the whole business. Facts are your anchor when emotions are tempestuous. Principle two, price is what you pay. Value is what you get. Distinction is everything. The market quotes you a price every day, but that price frequently has very little relation to the actual value of the underlying business. So in Yichen Jubaite Sensor Jul, the market was pricing businesses as if they would never again be profitable, never again pay dividends, never again contribute anything to their owners. This was clearly absurd for many companies. They had survived the worst economic collapse in history. If they could survive that, they would likely survive and eventually thrive when conditions improved. How do you determine value? This is where analysis comes in. You examine the balance sheet. What assets does the company own and what are they worth? You can often estimate liquidation value. If the company shut down tomorrow and sold everything, what would shareholders receive? You examine the income statement. What were earnings in normal times and what might they be when conditions improve? You look at the company's competitive position, its management quality, its industry structure. From this analysis, you derive a range of reasonable values. Then, and only then, do you compare that value to the market price. the margin of safety emerges from this comparison. If you calculate that a company is worth conservatively between $15 and $20 per share, you don't buy it, you don't buy it at $14. That's not enough margin for error. You wait until Mr. Market, in one of his pessimistic moods, offers it to you at $8 or $9. Now you have a significant cushion. Even if your analysis is somewhat optimistic, even if conditions worsen, even if you've missed some problems, you're unlikely to suffer a permanent loss at that price. This patience is difficult. Opportunities don't present themselves daily, but it's essential for preserving capital. Principle 3, market fluctuations are your friend, not your enemy. This is perhaps the most counterintuitive lesson for new investors. When you see your portfolio declining in value, every instinct screams at you to sell, to preserve what you have left, to avoid further loss. This instinct is reinforced by watching others sell, by reading fearful headlines, by the very human tendency toward loss aversion. We feel the pain of losses more acutely than the pleasure of equivalent gains. But if you've purchased securities with a margin of safety based on sound analysis of business value, then declines in market price represent opportunity, not danger. They allow you to buy more shares of businesses you already own at even cheaper prices. They allow you to deploy new capital at bargain valuations. Think of it this way: if you were buying a partnership interest in a local business, would you be upset if someone offered to sell you more of that business at a lower price than you originally paid, assuming the business itself was still fundamentally sound? Of course not. You'd be delighted. Yet investors in securities often panic in exactly this situation. The key phrase is fundamentally sound. If the business has deteriorated, if earnings have permanently collapsed, if management has made catastrophic decisions, if the competitive position has been destroyed, then price declines may reflect reality, not opportunity. This is why analysis is ongoing. You must continually reassess whether your original thesis remains valid. But if the business is sound and only Mr. Market's mood has changed, fluctuations are your ally. Principle 4, diversification protects against ignorance and hubris. Even the most thorough analysis can miss crucial factors. Management can be dishonest in ways that financial statements don't reveal. Industries can be disrupted by technologies you didn't foresee. Economic conditions can change in unexpected ways. Hubris, the belief that you've thought of everything, that your analysis is perfect, is dangerous. By diversifying across multiple securities, you ensure that inevitable errors don't destroy your portfolio. In my Yichen Zhou by Sanser Zhou purchases, 34 companies went bankrupt. Had I put all my capital into just one or two of those, I would have been wiped out. But spread across 104 companies, the bankruptcies were annoying, not catastrophic. The winners more than compensated for the losers. How much diversification is enough? This depends on your skill level. For the defensive investor, I suggest a minimum of 10 to 15 different companies in different industries. More is fine, perhaps 20 or 30. Beyond that, you're unlikely to gain much additional protection, and you may dilute your returns by forcing yourself to include mediocre opportunities. For the enterprising investor with the time and skill to do thorough analysis, perhaps 10 to 20 carefully selected securities provides adequate diversification while still allowing each position to matter to your overall results. Principle 5, understand the role of bonds in conservative investments. Stocks often receive all the attention, but bonds and cash equivalents play a crucial role, particularly for the defensive investor. They provide stability. They generate income without the volatility of equity prices. They give you capital to deploy when Mr. Market becomes particularly depressed and offers equity bargains. The proportion of your portfolio in bonds should reflect your circumstances and temperament. A younger person with steady income and decades until retirement can afford a higher allocation to stocks because temporary fluctuations don't matter. What matters is long-term value creation. An older person, depending on portfolio income for living expenses, needs more stability and should hold more bonds. But even young, aggressive investors should maintain some bond allocation, if only to provide buying power when opportunities arise. Okay? The quality of bonds matters enormously. I favor high-grade corporate bonds or government bonds over speculative junk bonds. The purpose of bonds in your portfolio is stability and income, not excitement. If you want to take risks for higher returns, take them in carefully selected stocks where you have some analytical. Principle 6, inflation is the silent destroyer of wealth. This is particularly relevant to bond investors, but affects everyone. A bond yielding 3% sounds safe and conservative. But if inflation runs at 4%, you're losing purchasing power every year. The dollars you receive can buy less and less. Over decades, this erosion is devastating. This is why stocks must be part of a long-term portfolio. Businesses, at least good businesses, have pricing power. They can raise prices with inflation, protecting the real value of their earnings. A company that earned $1 per share 50 years ago might earn $20 per share today, not necessarily because it's more successful relative to its era, but because the dollars are worth less and prices have risen accordingly. The stockholder benefits from this nominal increase in earnings, whereas the bondholder receives only the fixed interest payment in ever cheaper dollars. The defensive investor's 50-50 stock-bond allocation provides a balance. The bonds provide stability and income. The stocks provide inflation protection and long-term growth. Neither is perfect, but together they create a portfolio that can preserve purchasing power across decades while generating income and avoiding emotional trauma from excessive volatility. Principle 7, the four most dangerous words in investing are, "This time is different." I've watched markets for many decades now, and I've seen speculation and sound investment rise and fall in cycles. Each speculative mania has its own story, its own new paradigm that supposedly justifies extreme valuations. In the Ichen Jobat Arses, it was the permanent prosperity of modern industrial capitalism. In every era, there's some narrative that convinces otherwise rational people that traditional valuation metrics no longer apply, that we've entered a new era where old rules are obsolete. It's never different. Human nature doesn't change. Businesses are still valued based on their ability to generate cash for owners. Paying 50 or 60 times earnings for a stock is speculation, not investment, regardless of the growth story. Eventually, reversion to the mean occurs. Overvalued markets decline to undervaluation. Euphoria gives way to despair. The cycle continues because each generation believes it has discovered something new, when in fact, it's simply rediscovering the old manias in modern dress. The investor who understands this benefits in two ways. First, you avoid getting caught up in speculative manias. When everyone is excited, when stocks are priced for perfection, when the only justification for current prices is that greater fools will pay even more tomorrow, You remain on the sidelines or sell holdings that have appreciated beyond rational valuation. You look foolish for a while. Friends and family may again think you're missing out on easy money, but you preserve capital for the inevitable downturn. Second, when the cycle turns, when despair reigns and everyone swears they'll never touch stocks again, you deploy capital at bargain. This is what I did in Ichenjo by Sansujo. It's what I've done repeatedly across market cycles. It never feels comfortable. You're buying when everything looks terrible, but that's precisely when the mathematical opportunities are greatest. Principle 8, most losses come from buying what you don't understand. This is perhaps the most violated principle in all of investing. Someone hears about a hot stock at a cocktail party. The neighbor is making money on some new technology. A broker calls with an exciting opportunity. And without doing any analysis, without understanding the business, without calculating intrinsic value, without establishing a margin of safety, people buy. This is not investing. This is gambling, and the odds are poor. If you don't understand what a company does, how it makes money, what its competitive advantages are, what its financial position looks like, you have no basis for determining whether the current price is attractive. You're simply hoping that momentum continues, that other buyers will appear, that your ignorance won't be punished. Sometimes you'll get lucky. More often you won't. The solution is simple but demanding. Only buy what you understand. If you can't explain the business to a reasonably intelligent friend in a few minutes, if you can't stay within your circle of competence, this circle can expand over time as you learn and study, but never venture outside it for fear of missing opportunities. The opportunities within your circle are sufficient if you're patient. Okay, now let me address the psychology of all this, because that's really what determines success or failure for most investors. The mathematics of investing are not terribly complex. Calculating a price to earnings ratio requires only simple division. Understanding that you should buy when prices are low and sell when they're high is obvious logic. Yet most people do the opposite, buying when prices are high and everyone is excited, selling when prices are low and everyone is despairing. Why? Because investment success is not primarily about intelligence in the traditional sense. It's about temperament. It's about emotional control. It's about being able to think clearly when everyone around you is panicking or euphoric. These qualities are much rarer than high IQ. Help consider what was required of me in September. I had to borrow a substantial sum, for me at that time, an enormous sum, and invest it contrary to every signal the market was sending. War had begun. Stocks had been falling for a decade with only brief, unconvincing rallies. My family and friends thought I was mad. Every emotional instinct said to wait, to preserve what little capital I had, to avoid risk. And for 5 days after I invested, the market agreed with them, pushing prices lower and threatening to wipe me out through margin calls. To hold in that situation required faith, faith in my analysis, faith in the mathematics of value, faith in the historical tendency of markets to recover. But it also required something else, emotional detachment from the opinions of others. If I needed social approval, if I needed to feel smart and validated by others agreeing with my choices, I would have sold immediately. The ability to be comfortable being uncomfortable, to be patient when everything in you wants to act decisively when everything in you wants to wait, this is what separates successful investors from the crowd. I teach this to my students at Columbia. You're not trying to be brilliant. Brilliance, in fact, is often a handicap because it leads to overconfidence and complexity. You're trying to be disciplined and patient. You're trying to avoid serious mistakes. You're trying to maintain that margin of safety so that even when you wrong, and you will be wrong regularly, you don't lose significant capital. Now, think of it this way. If you make 10 investments and 9 of them provide modest positive returns of 10 to 20%, while one of them loses 50%, your overall results are poor. One serious mistake wipes out the modest gains from multiple successes. Therefore, your primary focus must be on avoiding those serious mistakes. How? By never buying without understanding what you're buying, by always maintaining a margin of safety, by diversifying so no single error is catastrophic, by being patient and waiting for Mr. Market's depressed moods rather than buying in his euphoric moments. The emotional challenge of this approach cannot be overstated. When you're following these principles, you will often look foolish. During bull markets, you'll lag the performance of speculators who are buying whatever is hot. Friends will tell you about their investment gains while you're being conservative, and you'll feel left out. During bear markets, you'll be buying when everyone else is. Let me share another principle that has served me well. Understand the permanent versus the temporary. Markets fluctuate. This is temporary. Business values, real values, not quoted prices, change much more slowly. A good business with competitive advantages, competent management, and sound finances doesn't suddenly become worthless because Mr. Market is depressed. Its earnings power may fluctuate with economic conditions, but the business itself persists. During the Great Depression, people genuinely believed that capitalism had failed, that we had entered a permanent new era of poverty and stagnation. So if you believed that, selling everything at any price made sense. But if you studied history, you knew that economic cycles were normal, that recoveries always followed depressions, that human ingenuity and productivity were not permanently destroyed by financial panics. The depression was temporary, even though it lasted a decade. The recovery was permanent, even though it would be interrupted by future recessions. Now, this perspective allowed me to buy in Ichenju by Sir John with confidence, despite the fear. I wasn't predicting when recovery would come. I couldn't know that, but I knew it would come eventually. And when it did, these businesses selling for pennies would be worth dollars. How long would I have to wait? I didn't know. But I was young, I had time, and the mathematics said that patience would be rewarded. Now, for older investors, this calculation changes. If you're 65 and depending on your portfolio for retirement income, you can't afford to wait a decade for recovery. Stability now. This is why younger investors can afford to be more aggressive, not reckless, but willing to maintain higher stock allocations and to hold through market cycles, because they have time for the permanent values to be recognized by Mr. Market. Another psychological challenge deserves mention: the difficulty of distinguishing between courage and foolishness. When I borrowed to invest in Ichenju by Sir John, was I courageous or foolish? The answer depended entirely on whether I had done proper analysis and whether my thesis about market overreaction was correct. After the fact, it looks courageous because it worked. Had it failed, it would look foolish. But in the moment, only I knew the quality of my analysis, the thoroughness of my research, the soundness of my reasoning. This is why I'm so insistent on process over results. You can make a good decision that leads to a bad outcome. This happens regularly in investing because the future is uncertain. You can also make a terrible decision that happens to work out through luck. What matters is not whether any single investment succeeds, but whether your process is sound. If you consistently buy securities with a margin of safety based on thorough analysis, diversified across multiple holdings, your long-term results will be satisfactory. Any individual holding might fail, but the portfolio will succeed. First, my family couldn't evaluate my process in Ichenjo by Sir John. They saw only that I was borrowing to buy stocks in the depths of a depression, and it terrified them. They weren't wrong to be concerned. Leverage is dangerous, and I was taking a substantial risk. But they couldn't see the hundreds of hours I'd spent analyzing financial statements, the careful calculations I'd made, the diversification I'd employed to reduce risk. To them, it looked like gambling. To me, it was calculated investment based on rational analysis and historical patterns. This brings me to an important question. Should you try to beat the market? My honest answer for most people is no. The effort required is substantial. The emotional discipline necessary is rare. The analytical skills take years to develop. And even with all of that, there's no guarantee of success. The defensive investor who simply holds a diversified portfolio of stocks and bonds, rebalances periodically, and doesn't try anything clever will almost certainly do better than the average investor who actively trades. If you do attempt to beat the market as an enterprising investor, you must be honest with yourself about whether you have the necessary qualities. Do you have the time to do thorough research? Can you remain rational when others are panicking or euphoric? Can you accept looking foolish for extended periods? Can you admit mistakes and learn from them? If the answer to any of these is no, you're better off as a defensive investor. There's no shame in this. You're simply recognizing your constraints and acting accordingly. Let me close with a reflection on what I learned from that experience in Yichen Jubai Sensor Jewel. Beyond the immediate financial success, I learned that the market is neither perfectly efficient nor completely random. It's a crowd of humans, subject to crowd psychology, capable of extraordinary swings between optimism and pessimism. These swings create opportunities for those who can remain rational and analytical. I learned that having your family doubt you is painful, but their approval cannot be your guide to investment decisions. They love you and want to protect you, but they may not understand markets or analysis. You must be confident enough in your process to act contrary to their wishes when your analysis supports it, while remaining humble enough to recognize when they might be seeing something you've missed. I learned that temporary losses are irrelevant if your analysis is sound and your time horizon is adequate. Those 5 days when I faced potential ruin were agonizing, but they didn't change the fundamental value of the businesses I'd purchased. If I could avoid forced selling through the margin call, which I barely managed, time would vindicate the strategy. I learned that leverage magnifies both gains and mistakes. I was fortunate that my analysis was sound and timing was eventually favorable. Had either been wrong, leverage would have destroyed me. I've been much more cautious about leverage since then, recognizing that while it worked once, it's a dangerous tool that should be used sparingly, if at all. Most importantly, I learned that the principles of sound investing, margin of safety, thorough analysis, diversification, emotional discipline, patience, really do work. Not every time, not without difficulty, but over time, consistently applied, they produce satisfactory results while avoiding catastrophic losses. This is really all we can ask of any investment philosophy. When people ask me now about that decision to borrow and invest in Yichen by Sensor Jewel, I tell them I was both lucky and prepared. Lucky in that the recovery came sooner than it might have, that I avoided forced selling during those terrible 5 days, that none of the companies I'd analyzed turned out to be frauds with fabricated financial statements, but prepared in that I'd done the analysis, understood the mathematics, maintained proper diversification, and had the emotional fortitude to hold through. The market will continue to fluctuate, Mr. Market will continue his manic depressive routine, offering wonderful bargains during his pessimistic phases and demanding ridiculous prices during his euphoric moods. Human nature will not change. Fear and greed will continue to drive prices away from rational valuations. If you can remain analytical when others are emotional, patient when others are impulsive, you will find opportunities, not every day, not every year, but regularly enough over a lifetime to compound your capital satisfactorily. And if your family doubts you, as mine did, show them your analysis, walk them through your reasoning, explain your margin of safety. But ultimately, you must trust your process and accept that sometimes being right means being alone in your conviction. This is the price of independent thought in markets. It's uncomfortable, but it's also where the opportunities lie. If everyone agreed that something was a bargain, it wouldn't be priced as a bargain anymore. The story of those 5 days when I thought I might lose everything has stayed with me not as a source of pride, but as a reminder of how thin the line can be between success and failure, between courage and recklessness. I tell this story to my students not to encourage them to take excessive risks, but to illustrate that even sound investment principles can be tested by circumstances, that even good decisions can face periods of doubt, and that the ultimate test of an investor is not brilliance but character. Let me elaborate on something that often confuses people, the relationship between business analysis and market timing. I've said that trying to predict short-term market movements is futile, yet I also advocate buying when Mr. Market is depressed. Isn't that a contradiction? Not at all. I'm not predicting that the market will rise next month or next quarter. I'm observing that when Mr. Market prices securities far below their intrinsic value, when you can buy a business for less than the cash in its treasury, or for less than its liquidation value, or for a small multiple of its normal earnings, you don't need to predict when recovery will come. You simply need to be confident it will come eventually, and that your margin of safety is sufficient to protect you while you wait. In Ichenjo by Senju, I had no idea whether the market would bottom the next day, the next month, or continue falling for years. Indeed, it did continue falling initially, which is what created those terrifying 5 days. But I knew that businesses selling for 50 cents that had $1 of value would eventually be recognized as bargains, whether that took 6 months or 6 years. The margin of safety meant I could afford to be wrong about the timing as long as I was right about the value. Okay? This is fundamentally different from market timing, which attempts to predict short-term price movements. The market timer says, I think stocks will rise next month, so I'm buying now and will sell when they've risen. This requires being right twice, right about the rise and right about when to sell. It's extraordinarily difficult, and most who attempt it fail. The value investor says, this business is worth substantially more than the current price, so I'm buying with a margin of safety and will hold until either the price reflects the value or my analysis proves wrong. You only need to be right once, right about the value, when the market recognizes it is largely irrelevant. Let me also address a question I receive frequently. What about growth? I've spoken primarily about buying undervalued securities, but what about companies with strong growth prospects? Shouldn't they command premium valuations? Growth is wonderful when you don't pay too much for it. A company growing earnings at 20% annually is clearly more valuable than one growing at 5%, all else equal. And this is crucial, if you pay a price that assumes the 20% growth will continue indefinitely, you're not investing, you're speculating. You're betting that the future will unfold exactly as you hope, with no margin for error. Consider the mathematics. A company earning $1 per share and growing at 20% will earn $6 per share in 10 years. Quite impressive. But if you pay 60 times earnings for that growth story, $60 for that $1 of current earnings, you need everything to go perfectly just to justify your purchase price. If growth slows to 15%, or if competition emerges, or if management makes mistakes, or if any of 1,000 things goes wrong, you'll lose money even though the company continues growing. You paid for perfection and got merely excellence, which is still a loss. Compare this to buying a company earning $1 per share for $8, 8 times earnings. Uh, Even if this company doesn't grow at all, you're buying earnings at a 12.5% yield. If it grows even modestly, you'll do quite well. If it surprises positively, you'll do extraordinarily well. And if something goes wrong, you have a margin of safety because you didn't pay much to begin with. This doesn't mean avoiding growth companies entirely. It means refusing to pay prices that require heroic assumptions about the future. It means recognizing that a good company at a wonderful price is superior to a wonderful company at a ridiculous price. This discipline prevented me from participating in various market manias over the years, and while I looked foolish during the manias, I avoided the devastating losses when reality failed to meet the absurd expectations. Another aspect of investment psychology deserves discussion: the tendency to confuse familiarity with safety. People often prefer to invest in companies they know, brands they use, businesses they understand from daily life. This is sensible to a point, as it keeps you within your circle of competence. But familiarity can create. Just because you shop at a particular store doesn't mean you understand its business model, competitive position, or whether the current stock price is attractive. I've seen investors pay ridiculous prices for familiar names during bull markets, assuming that companies they liked as consumers must be good investments at any price. The reverse is also true. Wonderful businesses can be overlooked because they're boring or unfamiliar. Some of my best investments over the years have been in unglamorous industries that most people never think about: industrial components, regional banks, specialized manufacturing. These companies lacked the excitement of growth stories, but they had solid finances, reasonable valuations, and competent management steadily creating value for shareholders. The lesson is to analyze businesses based on their fundamentals, not on whether they're exciting or familiar. A boring, profitable business at a cheap price is far superior to an exciting, money-losing business at an expensive price. At Wall Street often forgets this during speculative periods, but the mathematics are immutable. Okay, let me share one more personal reflection from those early years. After the success of the Chen Joe by Sensor June investments, I faced a different challenge: overconfidence. When your first major investment decision works out spectacularly, you can begin to believe you have some special insight, some ability to see what others miss. This is dangerous. Markets have a way of humbling those who become arrogant. I made mistakes in subsequent years. Investments that seemed sound but proved otherwise, companies whose management I misjudged, industries whose dynamics I misunderstood. Each mistake taught me something, usually about the limits of my knowledge or the importance of principles I'd neglected. The margin of safety protected me from catastrophic losses in these cases, but I still lost money and, more importantly, learned hard lessons about humility. The market doesn't care about your previous successes. Each investment decision stands alone. Just because you were right about one thing doesn't mean you'll be right about the next. This is why process matters so much more than results. If you follow a sound process and still make a mistake, you can learn from it and improve. If you abandon process and get lucky, you've learned nothing except to trust luck, which is a recipe for eventual disaster. One of the most valuable lessons from my decades on Wall Street is this: the more experience you gain, the more you realize how much you don't know. Young investors are often supremely confident, believing they've figured out the secrets to wealth. Older investors who've survived multiple market cycles are far more humble, having learned through painful experience that markets are unpredictable, that businesses can fail in unexpected ways, that even careful analysis can miss crucial factors. This humility manifests in practical ways. You maintain larger margins of safety because you know your analysis might be flawed. You diversify more broadly because you know that unexpected events can devastate individual companies. You're more patient about deploying capital because you know that today's Opportunity might be merely good, while next year's opportunity might be extraordinary. You're quicker to admit mistakes and sell when your thesis proves wrong because you've learned that hoping for recovery is not an investment strategy. But humility doesn't mean paralysis. You still act decisively when genuine opportunities appear. You still have the courage to buy when others are fearful, to hold when others are selling in panic. The difference is that your courage is grounded in thorough analysis and appropriate margin of safety, not in bravado or certainty about unknowable future events. Now, let me address one final psychological challenge that destroys many investors: the inability to accept small losses. I've watched investors hold losing positions for years, refusing to sell because I don't want to lock in the loss, or I'm waiting for it to come back. This is irrational. Whether you sell or hold doesn't change what happened. The loss already occurred when the security declined. The question is whether the current price represents a good investment going forward, not whether it would vindicate your original purchase. I make a practice of regularly reviewing every holding and asking, if I didn't own this security, would I buy it today at the current price? If the answer is no, I sell, regardless of whether I have a gain or loss. The past is irrelevant. Only current value and future prospects matter. This discipline prevents small mistakes from becoming large ones through inaction. Similarly, investors often sell winners too quickly, eager to lock in profits, while holding losers and hoping for recovery. This is exactly backward. Winners should be held as long as they remain undervalued or fairly valued. Losers should be sold when analysis indicates the original thesis was wrong or circumstances have changed. Changed. Your decision should be based on current analysis, not on whether you're sitting on a gain or loss. These psychological principles, humility, willingness to admit mistakes, focusing on current value rather than past purchase price, accepting being wrong while learning from it, are what separate successful long-term investors from the crowd that churns through capital without gaining either wealth or wisdom. Now, as I reflect on that period in Ichenju by Senzerjo and the decades since, several themes emerge that I believe are timeless and will remain relevant regardless of how markets or economies evolve. First, the fundamental nature of investment doesn't change. You're buying fractional ownership in businesses. The value of that ownership derives from the business's ability to generate cash for owners over time. But everything else, charts, technical patterns, momentum, market sentiment, is noise. Focused on the business, its competitive position, its finances, its management, and whether the price provides adequate margin of safety. Second, human psychology doesn't change. Fear and greed will continue to drive prices away from rational valuations. Crowds will continue to panic and stampede. Manias will recur with new stories but identical patterns. This creates opportunity for those who can remain rational and analytical when others are emotional. Third, patience is the investor's greatest advantage over professionals. Most professional money managers face quarterly performance pressures, redemptions during market declines, career risk from diverging too far from benchmarks. They cannot afford to be patient. You can. If you've done proper analysis and maintain adequate diversification, you can hold through market fluctuations, wait years for value to be recognized, ignore short-term performance. This patience compounds over time into extraordinary advantage. Fourth, the goal is not to maximize returns, but to avoid serious mistakes while achieving adequate returns. You can. If you've done proper analysis and maintain adequate diversification, you can hold through market fluctuations, wait years for value to be recognized, ignore short-term performance. This patience compounds over time into extraordinary advantage. Fourth, the goal is not to maximize returns, but to avoid serious mistakes while achieving adequate returns. Distinction is crucial. If you can avoid losing money, the power of compounding, even at modest rates, will build substantial wealth over decades. Most investors fail not because they didn't find enough winners, but because they suffered catastrophic losses from speculation, excessive leverage, or buying what they didn't understand. Fifth, know yourself. Are you temperamentally suited to be an enterprising investor, or should you embrace the defensive investor's approach? Both can succeed, both are honorable. What fails is pretending to be one while actually being the other, or attempting to be enterprising without the necessary time, skill, and discipline. When my family finally came to understand what I'd done in Sir John, when the portfolio had recovered and then flourished, they asked me what I'd learned from the experience. I told them then what I'm telling you now. I learned that markets are not efficient in the short run, that crowds can be spectacularly wrong, that mathematical analysis combined with emotional discipline can identify opportunities others miss, and that success requires the courage to be different and the patience to wait for reality to reflect value. Okay. But I also learned something else, something that took me years to fully appreciate. Success in investing is not primarily about getting rich. It's about preserving and growing capital in a way that allows you to sleep at night, that doesn't consume your life with anxiety, that provides resources for yourself and your family without requiring constant attention or brilliant market timing. The defensive investor who simply holds a balanced portfolio and rebalances periodically will, over a lifetime, accumulate substantial wealth without drama or anxiety. The enterprising investor who follows sound principles of analysis, margin of safety, and diversification can potentially do better, but at the cost of substantial effort and occasional periods of doubt. Both approaches work. Both are rational. The key is matching your approach to your circumstances, skills, and temperament. As I look back over my career, I'm proud not of any single investment success, but of having developed and taught principles that protect investors from their own worst impulses. The greatest service an investment advisor can provide is not hot stock tips or market predictions, but a framework for thinking about investment that keeps people from destroying their own capital through panic, greed, or ignorance. That framework begins with understanding what investment actually is. The commitment of capital today in expectation of receiving more capital, adjusted for risk and time in the future. It continues through principles of analysis, valuation, margin of safety, and diversification. And it concludes with psychological discipline, the ability to think independently, to be patient, to admit mistakes, to distinguish between the temporary and permanent. These principles saved me in Sir John when I borrowed to invest at what appeared to be the worst possible time. They've guided me through subsequent market cycles, through periods of panic and euphoria, through personal successes and failures. They're not magic. They're simply rational approaches to dealing with the uncertain future that all investors face. If I could leave you with one final thought, it would be this. Investment is not about predicting the future. It's about positioning yourself so that most possible futures work out acceptably well, and the probable futures work out quite well, while the worst possible futures don't destroy you. This is what margin of safety provides. This is what diversification provides. This is what buying businesses below their intrinsic value provides. You cannot control what markets do. You cannot control whether we enter recession or expansion, whether inflation rises or falls, whether your particular hold, but you can control your process. You can control whether you buy with a margin of safety. You can control whether you diversify adequately. You can control whether you hold through temporary fluctuations or panic and sell. You can control whether you buy what you understand or speculate on things you don't. Focus on what you can control, follow sound principles, be patient, admit mistakes, learn continuously, and perhaps most importantly, recognize that the goal is not to beat every other investor or to maximize every last percentage point of return, but to achieve your financial objectives while sleeping soundly at night.